In the equity community, the consensus is if the Fed cuts rates, that's good for equities. Historical track record, like you mentioned, is mixed, right? So what happens over the past, 4 easing cycles is when that has been followed by a recession, equities have sold off along with rates going lower. But in cases like 95 and 98, when the Fed was able to drag the economy away from a recession, equities have rallied. So really, again, this divergence tells you equity markets saying the Fed is going to ease and there's no risk of recession.
I just want to add one thing, Jonathan. We have proven over the last 30, 40 years that we can get through normal recessions. They come and go. It's part of the cycle. What we have a much more difficult time getting out of are these Fed-induced bubbles. It's true of 08, it's true of 2000, and we don't want to repeat that.
You think we're in one now?
It's starting to feel that way. If he goes with 3 cuts.
I don't know if we're necessarily in a bubble, but I think the important thing is that the Fed is listening, right? And I think if we've learned anything from the Fed is that they listen to the markets, and what the markets are telling them to do is to cut. So they might not cut today, obviously, but they're going to prepare for cuts down the road. And the question is, has the market got ahead of himself, the bond market specifically, got ahead of those cuts? Yes, it has a little bit, but directionally, where are things going? They're going to be going down. And the question is, are they going to be going down dramatically quickly, or are they going to be doing it in dribs and drabs over a period of time?
The irony and the skepticism we have is that financial conditions have eased since last September. This is the irony. With the rise in equity prices, the collapse in commodity prices and oil prices, and the collapse in treasury yields, financial conditions have eased. So if you're listening to the market itself, you don't have to necessarily cut today.